Kia ora everyone, welcome to our next edition of Econ Talks. Gareth, we've had the Reserve Bank issue its latest monetary policy statement after a fairly tumultuous 24 hours, if you will. New Zealand's now back at alert level 4. I'm trying to figure out how to work from home from a different desk setup. The Reserve Bank, though, deciding because of this lockdown period not to raise the official cash rate, instead opting to hold it at 0.25% still. Was that the right move?
I think there's a heck of a lot of uncertainty out there at the moment, and that is, reinforced by the sudden move from level 1 to level 4 in the space of a few hours. And while the economy is facing that level of uncertainty, I mean, we have no idea how long this lockdown might last. We know it's the Delta variant. We know there's been 7 cases identified, but really not a lot beyond that at this stage. So I think it's prudent from the Reserve Bank to say, well, hold on. We know there's a lot of inflationary pressure. We know there's a lot of labour market pressure, but for now, we'll just sit on our hands. And, if things improve in a couple of weeks' time and we come out the other side, then we can start thinking about raising those interest rates again. But for now, the last thing anybody wants is for the Reserve Bank to be tightening like nothing had changed in the last day, because we know that things have changed. And so, yeah, that's my thinking around that. I mean, it's come through in terms of their forecasts as well, obviously. They've been prepared well before the lockdown occurred, but it does give us an indication of what their thinking is around where the OCR is going to go over the next couple of years if we do return to normal.
Yeah, absolutely. And I think that's the interesting thing is reading the statement, it's quite clear that the Reserve Bank now views the need to reduce monetary stimulus as key. There is not as much need for continued levels of support like we have them. We still need support, just not nearly as much. And those forecast tracks from the Reserve Bank showing that they expect, in a sense, at present, the official cash rate to increase by around about 50 basis points by the end of this year, another 100 basis points after that in the 2022 year, and then a little bit more following. So we are looking at continuous rises to the official cash rate, interest rates heading higher, still below that sort of neutral interest rate level, so still stimulatory conditions, just not nearly as hardcore as we've currently seen it. What I found interesting as well was that you do get the feeling that the bank is still considering what it's best to do in the broader monetary policy space. They've made it clear there's no changes to the funding for lending program, but they have asked staff for operational thoughts around what to do with their current bond purchases. No details yet on what that might mean, but it does imply that they could either be looking at how they might sell back into the market, or at least what that purchase profile that they've currently built up might look like. Again, just highlighting that feeling from the Reserve Bank that now is the time to raise rates to reduce or unwind that monetary stimulus that we're currently seeing. Looking, though, wider, Gareth, at their statement this time and at their forecast, what are we seeing there in terms of their economic track? Are we in for a pretty good few years, or what's the mixed bag that we might be faced with?
Yeah, one of the interesting aspects was their GDP forecasts and their household spending or private consumption forecasts. A bit of a shift there where still good growth continuing through 2022, all things considered and going along largely as normal. But then out into 2023 and beyond, there were signs of the Reserve Bank showing that they thought the economy would be growing at a slower rate on a more sustained basis over those following couple of years. And that aligns with what our thinking had been. We've had a lot of stimulus, both fiscal and monetary, over the last 18 months or so applied to the economy. We've seen massive spending growth through that time, particularly in terms of household spending coming through as well. And because interest rates have been low, households have money in their pocket and they've made the most of it. But it does mean that it's harder to achieve much growth in terms of some of those variables further out, because we've front loaded everything. We've spent while the going has been good and the interest rates have been low. We don't have so much going forward, and a bit more susceptible, or sensitive rather than susceptible, to interest rates as they start to rise and take some of that money that was previously in our pockets back out again. So an interesting shift there. A couple of other interesting variables, I think, which you sort of picked up on, were their inflation and also their unemployment forecasts.
Yeah, and the inflation one was particularly interesting. Of course, we know at the moment that inflation is certainly rising, the highest inflationary pressures we've seen in quite a while. The Reserve Bank, though, still feeling that a lot of that pressure is somewhat temporary. At the moment, they're looking at having inflation running above 4% at the end of this year, but dropping back down towards 2% over the forecast period. Now, that's in contrast to our own expectations that the inflation rate holds up at a high level, but also holds up more generally throughout the forecast period. So they're feeling at the moment from the Reserve Bank's point of view that some of these price increases temporary, particularly our supply chain issues and similar. Interestingly, though, their expectations around the labour market seem a bit more persistent. They do think that that tightness that we're currently seeing is here to stay for a bit. Only picking that inflation falls to a low of 3.8%. Remember, it's already 4%, and it decreased by 0.7 percentage points already just in the last quarter. The feeling is from the Reserve Bank that we are at or probably above maximum sustainable employment. Those pressures in the labour market will be pushing on into wages and similar. All of this, though, suggesting that without international skilled migrants able to come into the country, our labour market remains constrained. And like you said, with those high levels of spending, that high level of economic demand, it's actually quite hard to resource that, which means that at some point those pricing pressures do come up, and eventually once we start to unwind it, you have a slightly softer trend growth. Just to profile what that looks like, you were discussing the GDP expectations before. The Reserve Bank expecting that quarterly growth averages 0.6 between now and the end of 2022, but only averages 0.3 thereafter, a halving essentially in quarterly growth. It is a considerably slower period than what we are currently expected to experience. All of this suggests that we are likely, though, to continue having those higher interest rates moving forward. We've seen some of the retail banks move ahead with those raising expectations already, and the Reserve Bank making it abundantly clear today that they expect to be lifting the official cash rate going forward. At the moment, barring any catastrophic challenge to the economy, and alert level 4 actually so far hasn't suggested anything untoward, we would expect to see the official cash rate go higher, for interest rates to head the same way, and for a bit of a readjustment in terms of what New Zealanders do when it comes to their lending, their spending and their savings. We'll have a look at that and everything else that the Reserve Bank does in the future on one of our future editions of Econ Talks.